All right, welcome everyone to this meticulously designed deep dive just for you. We totally get it. Your goal is exam mastery in biotechnology from a commerce perspective. And particularly, you want to nail down those income tax implications when it comes to your salary. You need that precise, granular analysis to really conquer those exams.
Absolutely. We're diving deep today into income chargeable under the head salaries, all according to the Income Tax Act of 1961. We're going to unpack definitions, those taxability rules, exemptions, and deductions, all with really meticulous detail. This in-depth knowledge is going to be your bedrock for exam prep, making sure you're ready to handle even those complex scenarios with confidence.
Perfect. So to map out our journey, we're going to start by scoping out the full extent of taxable salary income, right? Then we'll get into how this income is actually charged to tax. After that, we'll really define what we mean by salary. Perquisites, those are the juicy benefits and profits in lieu of salary. We'll also cover what incomes are specifically excluded from salary, followed by deductions under Section 16, and wrap up with deductions under Chapter 6AA. So let's jump right in. What kind of income even falls under this salaries umbrella?
The absolute cornerstone for income to be taxed under salaries is a genuine employer-employee relationship. What this means is that the employer has control over how the employee does their work. If you don't have that relationship, well, the income gets taxed under profits and gains of business or profession if it's for independent services, or it goes under income from other sources if it doesn't fit neatly anywhere else.
Right, so it's about the nature of the work arrangement, not just the fact that money is changing hands. Now, assuming we have that employer-employee relationship, what are the actual payments and benefits that we classify as salaries? It's more than just your regular paycheck, right?
It is indeed. The scope of salaries is actually quite broad and captures a variety of ways you can be compensated. First, of course, we have wages, which is your basic pay. Then you've got annuity or pension, which are regular payments you receive after retirement, sort of like deferred salary. And then there's gratuity, a lump sum payment for those who've given long and commendable
Okay,
service.
those are kind of the standard ones, but it gets a bit more intricate, right? What about those extra perks and payments that come with the job?
Precisely. We also include fees, commissions, and bonuses. These are all additional payments, often tied to performance targets, completing specific tasks, or rewards. And then we have perquisites. These are those non-cash benefits that can be quite valuable, like a company car or even rent-free accommodation provided by the employer. We'll dissect those a bit more later. And then there's profits in lieu of salary. This is compensation you get when your employment is terminated, or maybe the terms of your employment change significantly.
Right, like a severance package if you're let go.
Exactly. Now, we also need to consider different timings of payments. There's advanced salary, which is payment you get before you've actually earned the income, and arrears of salary, which is payment for work you did in the past. Both of those are taxable, and we'll talk about when exactly that happens. We also have leave encashment, which is basically cash you get in exchange for any unused vacation time.
And all of this is considered salary for the purposes of income tax.
Yes, all of these components are added together to make up your gross salary income. But wait, there's more. We also have to consider employers' contributions to things like the Recognized Provident Fund, RPF, or the National Pension System, NPS. Now, only the portion of these contributions that exceeds specified limits is taxable. For RPF, anything your employer contributes above 12% of your salary is taxable. NPS has a different set of rules and limits, and we'll delve into those in detail later, particularly concerning Section 80 CCD. There's a very important point to remember here. Recent amendments have introduced this aggregate limit of 7.5 lakhs per year for employer contributions across RPF, NPS, and approved superannuation funds. What this means is any interest or return on contributions that go above this limit is now also taxable. This new limit is especially important for higher earners because it could mean a bigger tax liability for them.
That's definitely a huge change that everyone needs to be aware of. What about the interest that accumulates in these funds, like your PF account? Is that taxable too?
It can be. Interest credited to your RPF account is taxable if it exceeds the rate notified by the government, which is currently 9.5% per year. And finally, let's say you have a transferred balance from an unrecognized provident fund into a recognized one. The part of that balance that represents what your employer initially put in, plus the interest earned on those contributions, becomes taxable at the time of the transfer.
Wow, that's a pretty comprehensive list.
Yeah.
So what happens if you've worked for more than one employer during the same financial year? Does that complicate things?
Not really. In that case, all the salary you receive from every employer during that year gets clubbed together and taxed under this single salaries heading. It doesn't matter if you worked for 2 companies or 10, it all gets lumped together. And just to reiterate, salary from a former employer, like your pension, and salary from a future employer, like a signing bonus, which is considered advance salary, are also both taxable under this head in the year they're received or become due.
And just to be absolutely clear, does the nature of the payment, like whether it's something your employer has to pay you versus something they choose to give you, like a bonus, does that make a difference in terms of tax?
No, it does not. Whether the payment is compulsory, meaning it's written into your employment contract, or it's a voluntary payment that your employer decides to make, like a performance bonus, it's still all considered part of your salary income and gets taxed under this salary's head. The key here is that employer-employee relationship. That's what determines how the income is classified.
Okay, that really sets the stage for what we include under salaries. Now, let's shift gears a bit and talk about when this income becomes taxable. You mentioned this due basis or receipt basis, whichever is earlier principle. Can we break that down a little further?
Of course. Section 15 of the Income Tax Act is what governs the basis of charge for salary income, and this due or receipt, whichever is earlier principle, is really at the heart of it. So first, let's consider the due basis. What this means is, even if you haven't physically gotten your hands on the salary in a given year, if you have the right to receive it, meaning it's become due, then it's considered taxable in that year. Let's take your salary for March 2024 as an example. Even if it hits your account on, say, April 5th, 2024, it relates to work done in the previous year, 2023-24, which ends on March 31st, 2024. Because of that, it's considered due in that previous year and will be taxed in the assessment year, 2024-25. This principle makes sure that income is taxed in the year when you earn the right to receive it or actually have it in hand, preventing any potential for putting off paying taxes.
So basically, the financial year when you actually earn the income sometimes matters more than the exact date when the payment is processed.
Precisely. Now, let's look at the receipt basis. This comes into play when you receive salary before it's actually due, like in the case of advance salary. If you get an advance, let's say in December 2023, for work you'll be doing in January and February 2024, that advance is taxable in the previous year, 2023-24, the year you actually got the money. But to avoid being taxed twice on the same income, when that salary actually becomes due in January and February 2024, it won't be taxed again.
That makes sense. We don't want to penalize you just because of the timing of the payment. What about arrears of salary? That's also a situation where the receipt basis applies, right?
You're right. If you get arrears of salary in the current year that are for work you did in past years, those are taxable in the year you receive them. However, the Income Tax Act recognizes that getting a big chunk of money all at once for past work could bump you up into a higher tax bracket, which wouldn't be fair. To deal with this, Section 89 lets you claim relief. Essentially, it allows the tax to be calculated as if you received those arrears in the years they were actually earned. It's a way to spread out the tax burden and make it more manageable.
That's good to know there's a mechanism to help with that. So if we're summarizing this basis of charge, the tax authorities look at two key points: when the salary becomes legally due to you and when you actually receive it. Whichever of those two things happens first is when that income gets added to your taxable income for that year.
Exactly. That earlier of principle is what governs when salary income is included in your tax calculations.
Perfect. So we've got a solid grasp of how direct monetary compensation is treated as salary. Now let's zoom in on another crucial part of employee benefits, those perquisites under Section 17(2). All those non-cash goodies.
Right. Those perquisites, often just called perks for short, are essentially benefits or special things that your employer gives you, either completely free or at a discounted price on top of your normal salary. These come directly because you're an employee, and they can be in the form of actual things or services, or even cash sometimes. It's important to remember that all these perks have a value associated with them, and that value often ends up being taxable.
And how do we actually figure out what that value is? It can't always be as straightforward as a cash bonus.
You're absolutely right. The valuation of perquisites is a fairly detailed process that's governed by Rule 3 of the Income Tax Rules, 1962. This rule sets out the specific methods for calculating the taxable value of all the different kinds of perquisites out there. We won't get bogged down in the nitty-gritty of each valuation method right now, but it's really important to know that these rules exist and they provide the framework for figuring out how much of that perk's value will be added to your taxable income.
Okay, so we have this set of rules that basically assigns a monetary value to those benefits you get as an employee. Now, you mentioned that we can categorize perquisites based on how they're taxed. Can you walk us through those categories?
Sure. We can generally group perquisites into three main categories: those that are taxable for every single employee, Those that were traditionally taxable only for what they called specified employees, although this distinction is becoming less important nowadays, and then those perks that are completely tax-free or exempt. Let's start with the ones that are taxable for all employees.
Okay, so what kinds of benefits fall into that category, the ones that everyone had to pay tax on?
A big one is rent-free accommodation, or RFA. If your employer gives you a place to live without you having to pay rent, that perk has a taxable value. How much that value is depends on a few things: whether the accommodation is furnished or not, whether your employer owns the property or is just renting it, and whether you're a government employee or not. For those who aren't working for the government, the valuation is often based on a percentage of your salary and also takes into account the population of the city where you're living.
Right, so I'm guessing living in a fancy company-provided apartment in a major city is going to have a higher taxable value.
You got it.
Hmm.
Closely related to RFA is accommodation at concessional rent. This is when you're paying rent, but it's below the fair market value, which we determine using those RFA rules. The difference between what the accommodation would normally cost under RFA and the rent you're actually paying is what's considered a taxable perquisite.
Makes sense, because you're basically getting a discount, a benefit equivalent to that difference.
No.
What else is taxable for everyone?
Another key one is when your employer meets an obligation that was yours. This means they're paying for something that legally or contractually you were supposed to pay yourself. Some common examples are if your employer pays your personal bills directly, like your electricity, gas, or water bills, or if they cover your membership fees for a club, or even if they pay your income tax for you. All of those are considered taxable perquisites. Along the same lines, if your employer is paying the premiums for a life assurance or annuity contract for you, that's also a taxable perk, unless those payments are going into an approved superannuation fund or an RPF.
So basically, it's like your employer is taking over some of your personal financial responsibilities.
Exactly. And then there are specified security or sweat equity shares. These are shares that your employer or maybe even a former employer gives you or transfers to you, either directly or indirectly. You might get them for free or maybe at a discounted price. The key here is they're taxable in the year you get them, and the taxable amount is based on their fair market value, which is essentially what they would cost if you bought them on the open market on that day. We also need to remember those retirement funds we talked about earlier. Any employer contributions to an approved superannuation fund that go above $1,050,000 per year per employee are considered a taxable perquisite. And as we already mentioned, this is also linked to that overall 7.5 lakh limit for contributions across all your different retirement funds. Finally, we have fringe benefits. This is kind of a broad category, and it covers other perks like loans from your employer that are interest-free or have really low interest, the use of stuff that your employer owns, like a company car maybe, and the transfer of those assets to you at a price that's below their actual market value.
Okay, that's a really good overview of the perquisites that are taxable for everyone. Now, what about the ones that used to be linked to specified employees? You mentioned that this distinction isn't as important anymore.
Right, it's becoming less relevant. Specified employees usually meant someone who was a director in the company, had a significant stake in the company, or was making a high income above a certain threshold. Whether you were a specified employee used to determine if certain perks were taxable or not. But because of changes in the rules, a lot of those perks are now taxable for everyone, regardless of their status. Some examples of what used to fall under this category include the motor car facility. If your employer provides you with a car for work and/or personal use, figuring out its taxable value can get complicated. It depends on who owns the car, who's paying for gas and maintenance, how big the engine is, and how much you use it for personal stuff versus work stuff.
Yeah, that sounds like it could get really tricky to value accurately.
It can be, and there are specific calculations in the rules based on all those different scenarios. Some other examples from this category are things like having domestic help that your employer pays for, like a sweeper, gardener, watchman, or personal attendant. If you get gas, electricity, or water from your employer's sources, or they buy it for you, that's also usually a taxable PUC. Educational facilities for your family members, especially if it's at a school or college that your employer owns, falls under this category too. However, there's an exemption up to 1,000 euros per month per child if they're starting in an institution that the employer owns. Finally, if you work for a transport undertaking, like a railway or an airline, and you get free or discounted travel, that's another example.
So even though this specified employee distinction is fading away, these kinds of benefits still often end up being taxable in some way. All right, now for the good news. What are the perks that are completely tax-free?
Ah, yes, the good stuff. There are actually quite a few tax-free perquisites that employees should definitely know about. One of the big ones is medical benefits. This covers things like reimbursements for medical expenses that you or your family incur in India, up to certain limits, of course. If the medical treatment is provided in a hospital that your employer owns or a government hospital, it's generally tax-free. And
Yeah.
usually, when your employer pays your health insurance premiums for you, that's also exempt.
That's definitely a relief because healthcare costs can really add up. Anything else on that tax-free list?
Another very welcome exemption is the leave travel concession, LTC, which we mentioned earlier, also has an exemption under Section 10(5). This covers travel expenses within India for you and your family, but there are specific rules about what kind of travel is covered, how much you can claim, and how often you can use it. Usually it's twice in a 4-year period. And then there are some everyday perks that are tax-free, like refreshments that are provided to you at work, or subsidized lunch or dinner that you get during working hours, which is exempt up to €50 per meal. If your employer provides recreational facilities that are available to all employees, like a company gym or a sports club, those are also tax-free.
So those are the nice little perks that help keep employees happy without adding to their tax burden.
Exactly. If you get reimbursements for telephone or mobile expenses that you racked up for work, that's exempt too. And of course, there are employer contributions to provident funds and pension funds. Those are tax-free, but only up to the limits we discussed earlier. If you get small gifts in kind from your employer, those are also tax-free up to a total value of €5,000 per year. But here's a little catch. If those gifts are in cash, they're fully taxable. Another tax-free perk is the use of a laptop or computer that your employer provides. It doesn't matter if you're using it for work or personal stuff, it's exempt. Scholarships that your kids get based on merit are also exempt. And finally, if you're an Indian citizen working for the government and you get perks while you're working outside India, those perks are usually tax-free.
That's a great rundown of all those exemptions. Now, let's move on to the last of the three definitions we need to cover from Section 17, which is profits in lieu of salaries under Section 17(3). Can you explain exactly what that covers?
Sure. Profits in lieu of salary essentially means any money you get from your employer or even a former employer that's either on top of your regular salary or is meant to replace your salary. This usually happens when your job ends or your employment contract changes, or sometimes it's related to specific funds or insurance policies.
So, it's not your usual regular paycheck. What kinds of payments fall under this category?
Section 17(3) specifically lists out several types of payments. First, we have compensation for termination or modification of employment. This is any money you get when your job ends or the terms of your job change. Severance pay that goes beyond the legal limits would fall under this. Then there's payments from unrecognized funds. If you get a payment from a provident fund or a superannuation fund that wasn't officially approved by the Income Tax Act, the part of that payment that represents what your employer put in plus the interest earned on that money is treated as profits in lieu of salary.
So those are funds that didn't meet the government's requirements for recognition.
Exactly. We also include payments under a Keyman insurance policy if you receive any sum from a Keyman insurance policy, including any bonus that's given out on that policy that's considered profits in lieu of salary. And finally, we have certain lump sum payments. This can be any amount that you're owed or you receive, whether it's one big payment or spread out in installments. You might get this before you even start working for someone or after you've left a job, as long as it's related to your past work or future work. For instance, a signing bonus you get before starting a new job or a payment you get after you leave that's tied to your service there would fall under this.
Okay, so these are usually one-time payments rather than part of your regular salary. How are these profits in lieu of salary taxed then?
These are fully taxable under the income from salaries category in the year that you get them. But just like with arrears of salary, if you get a big lump sum, like a big payout when your job ends, it could push you into a higher tax bracket that year, which might not be fair. So in certain cases, Section 89 might allow you to get some relief to help with that. It essentially lets you spread the income out over the years it actually relates to.
Yeah, that Section 89 relief seems like it could be really useful in some situations, so it's a good thing for our listeners to keep in mind. Now, we've covered in detail what is included under salary. Let's switch gears now and talk about what is not included, meaning the income that is specifically exempt from salary tax under Section 10.
Right. Section 10 of the Income Tax Act gives us a whole list of incomes that are totally exempt from income tax. A lot of those exemptions are directly relevant to things that might otherwise be considered salary income, so they essentially reduce how much of your salary you actually have to pay tax on.
Let's start with the leave travel concession, LTC, under Section 10.5. Since we mentioned that as a tax-free perquisite as well, what are the specifics of that exemption?
The exemption under Section 10.5 specifically applies to money you get from your employer to help with travel within India for you and your family. But there are conditions. First, it has to be for travel within India, not international trips. Second, there are rules about what kind of transportation you use. Usually, it has to be by air, economy class for domestic flights, first class or AC train travel, or by bus. The exemption amount is usually capped at what you actually spend on the trip. And lastly, you can generally use this exemption for a maximum of 2 trips in a 4-year block.
Okay, so it's not a free-for-all travel pass. There are definitely rules you have to follow. What about gratuity under Section 10?
Okay, so any gratuity that government employees receive, those working for the central government, state governments, or local authorities, is completely exempt from income tax. For people who aren't government employees, the exemption depends on whether they're covered by the Payment of Gratuity Act 1972. If they are covered, the exemption is the lowest of 3 amounts. The actual gratuity they get, a 20,000, which used to be your 10,000, but they raised it, or 15 days salary for every year they worked, calculated based on their last salary. If they're not covered by that Gratuity Act, the exemption is the lowest of these 3 amounts. The actual gratuity, 10,000 or half a month's average salary for each year they worked.
So different rules apply based on whether your employer falls under that specific law. What about commuted pension under Section 10?
If you choose to get your pension as one big lump sum, that's called commuted pension. For government employees, any commuted pension is totally exempt from tax. But for non-government folks, whether it's exempt depends on if they also get gratuity. If they do get gratuity, then a third of the total pension they would have been entitled to is exempt. If they don't get gratuity, then half of that total pension is exempt. It's worth pointing out that the regular pension payments you get over time, the uncommuted pension is always fully taxable as salary income.
So basically, you get a potential tax break if you take the lump sum instead of the regular payments. Okay, let's talk about leave encashment now. Under Section 10.10a.
All right, so for government employees, any leave encashment they get when they retire is totally tax-free. For those in the private sector, when they retire, the exemption depends on which of these 4 amounts is the smallest. The actual amount of leave encashment they receive, 25,000, they bumped this up from 3,000, 10 months worth of their average salary, or the cash equivalent of the leave they didn't use, based on a maximum of 30 days of leave per year of service. Here's the important part. Any leave encashment you get while you're still working is fully taxable. The exemption only kicks in when you retire.
So it's like saving up that leave time until you retire to try and get that tax benefit. What about retrenchment compensation under Section 10.10b?
If your employer gives you compensation when you're retrenched, meaning your job is terminated, and this is all defined under the Industrial Disputes Act of 1947, there's an exemption for that compensation. The exempt amount is whichever of these is the smallest. The actual compensation you got, the amount you'd get based on the rules in the Industrial Disputes Act, or 5,000.
And how about compensation on voluntary retirement, also known as VRS, under Section 10.10c?
If you decide to take voluntary retirement under a scheme that's been approved by the Chief Commissioner of Income Tax, any compensation you get is exempt up to 5,000 ARD. A lot of employees in public sector companies or local authorities are often covered by these kinds of approved schemes.
Okay, let's move on to a big one. Provident fund payments. Under Sections 10, 11, and 10, there are different types of provident funds, right?
Yes, there are. Generally speaking, the money that builds up in your statutory provident fund, SPF, or recognized provident fund, RPF, is exempt from tax when you take it out, as long as you meet certain requirements, like working for a certain number of years. The interest that your RPF earns is also exempt up to that notified rate, which, as we said before, is 9.5% right now. And on top of that, whatever your employer puts into your RPF is exempt up to 12% of your salary.
So as long as you're within those contribution and interest rate limits, your PF benefits stay pretty much tax-free when you finally withdraw them. What about superannuation fund payments under Section 10.13?
Any money that you or your legal heirs receive from an approved superannuation fund is generally tax-free. This usually applies in situations like death, retirement, or if you become incapacitated and can't work anymore. But of course, there are specific rules and conditions that these approved funds have to follow.
Now, one of the most common exemptions that salaried individuals use is house rent allowance, HRA, under Section 10.13a. Can you explain how that works?
The HRA exemption is meant to help out people who are getting a HRA from their employer and are paying rent for where they live. How much of your HRA is actually exempt from tax depends on which of these 3 amounts is the smallest. The actual HRA you got from your employer, the rent you paid minus 10% of your salary. And for HRA, salary includes your basic salary, any dearness allowance if it's part of your retirement benefits, plus any commission you get that's a fixed percentage of your turnover or 50% of your salary if you live in a metro city like Delhi, Mumbai, Chennai, or Kolkata, or 40% of your salary if you live anywhere else. So you have to do a little math, compare those three numbers, and the smallest one is the amount of HRA you can claim as exempt from tax. Understanding how salary is defined for HRA is super important because it's not just your basic pay.
That's a formula to memorize for sure. Okay, last but not least, let's cover special allowances under Section 1014. These sound like they're for specific work-related expenses.
You're right. Section 1014 gives exemptions for certain allowances that employees get to cover the costs of doing their jobs. These are broadly divided into two categories. Under Section 1014, some allowances are fully exempt, but only up to the amount that you actually spent on those work-related expenses. For example, we have travel allowance for official trips, daily allowance to cover your expenses while you're on those trips, conveyance allowance for getting around while you're on official duty, helper allowance so you can hire an assistant to help you with work stuff, uniform allowance for the cost of work uniforms, and research allowance. The catch here is you need to keep good records to prove that you actually incurred these expenses.
So it's like a reimbursement for out-of-pocket work cost.
What about Section 1014?
Yeah.
Okay, under Section 1014, there are some other allowances that are exempt up to a certain limit, regardless of how much you actually spent. Examples here are things like children education allowance, which is exempt up to a €100 per month per child for a maximum of 2 children. Then there's hostel expenditure allowance, which has an exemption of up to €300 per month per child, also for up to 2 kids. There used to be a transport allowance exemption here too, mainly for people who are blind or orthopedically handicapped. But for most other employees, the standard deduction we talked about earlier has basically replaced the benefit that this allowance used to provide. It's worth noting that since they introduced the standard deduction, a lot of these smaller fixed allowances aren't as important for tax planning as they used to be.
That makes sense. The standard deduction definitely simplified things for a lot of people. So just to really hammer this home, these exemptions under Section 10 are super important because they directly reduce your gross salary before you even start factoring in any other deductions.
Exactly. Understanding these exemptions and whether you qualify for them or not is crucial for accurately figuring out your taxable income from salary. It's a key part of effective tax planning.
All right, we've covered what salary income is, when it's taxable, what all the different components are, and what parts of it you might be able to exempt. Now, let's dive into the deductions that are specifically for income from salary, the ones under Section 16 of the Income Tax Act. And remember, these deductions come after we've figured out your gross salary and subtracted any exemptions you're eligible for under Section 10.
That's right. Section 16 gives us 3 specific deductions that you can only claim from income that's classified under the salaries category. The first one, and the one that applies to the most people, is the standard deduction under Section 16.
That's the nice flat deduction that everyone gets, right? Can you tell us more about that?
Yes, exactly. The standard deduction is a fixed amount that every salaried employee and pensioner can claim. For the current tax rules, the standard deduction is €50,000, or whatever your actual salary or pension income is, whichever is less. The great thing about the standard deduction is you don't need receipts or any proof that you spent that money on anything specific to claim it. They introduced it a few years ago, and it essentially replaced the old exemptions for transport allowance for most people and medical reimbursements. Importantly, this standard deduction is available whether you're using the old tax regime or the new tax regime, which is under Section 115 BAC. That makes it a really universally applicable benefit.
Simplicity is always good. What's the next deduction under Section 16?
Next, we have the deduction for entertainment allowance under Section 16(2). But there's a really important point here. This deduction is only for government employees, those who are working for the central or state governments. If you're not working for the government and you get an entertainment allowance, it's all included in your gross salary, but you don't get to deduct anything under this section. For government employees, the entertainment allowance is first added to their gross salary, and then they can claim a deduction, but only up to the smallest of these 3 amounts. The actual amount of entertainment allowance they got during the year, $5,000, which is a fixed limit, or 20% of their basic salary, and that doesn't include any allowances, perks, or other benefits. So you got to calculate all 3 of those, and the smallest one is what you can actually deduct.
So that's a pretty specific deduction with some tight restrictions, mainly for government folks. What's the final deduction under Section 16?
The last one is for professional tax, which is sometimes called tax on employment under Section 16(3). It's a tax that various state governments levy on people based on their job or their profession. The deduction you get under Section 16(3) is for the amount of professional tax that you actually paid during the year. You have to have actually paid the tax to claim this deduction. Now, here's a situation that comes up sometimes. Employers will pay the professional tax for their employees. When that happens, the amount the employer paid is first added to the employee's gross salary as a